Good afternoon, everyone, and welcome. My name is Kimberly Brown, and I'm a college planning specialist at Education Quest Foundation. And in honor of Financial Aid Awareness Month, we've teamed up with Bellevue University to create Financial Fridays. This is a series of 5 20-minute webinar sessions designed to provide you the information you need on financial aid. Today's session is the third session, and so I'll be providing information and answering some of the most common questions as it relates to student loans and knowing before you owe. Throughout today's session, you will be in listen mode only, which means you are muted. We are recording the sessions, so those of you who are not able to attend today can view it later. If you would like a copy of today's presentation and recording, a link will be emailed to you following the webinar. Okay. I encourage you to type your questions and comments in the question and answer box, and Angie, our moderator here, will track your questions and I will address them live at the end. If you have questions related to your specific situation, we just ask that you include your name, email, and phone number so that we can follow up with you directly to ensure your questions are fully answered. All right, so with that being said, we're going to get to today's topic. Okay, so today I'm going to cover pros and cons of student loans, interest rates, repayment options, and how to manage student loan debt. Okay, so let's dive in here. There are two types of student loans, federal student loans and private loans. If you're trying to figure out, how you're going to pay for school, you've likely thought about both. Federal and private student loans are not the same, and it's important for you to know the difference and know the pros and cons. Federal student loans are funded directly by the federal government, and to apply, you need to complete the free application for federal student aid, or the FAFSA, which was covered in previous FAFSA Friday sessions. So you can view those still because they were recorded. And private student loans, sometimes referred to as non-federal or alternative loans, are made and funded by private lenders such as banks and online lenders. So your question might be, which is better? Which is better for you? So it depends on you and your overall financial picture. Some key variables to keep in mind is the benefits of federal student loans versus private. So federal versus private. There are some benefits of federal loans, which include the interest rates and fees are set at the start of each academic year and remain fixed for the life of the loan. So it's not variable. There are repayment assistance options, including income-based repayment plans and subsidized loans for those of you who demonstrate need. A private student loan might offer a lower interest rate depending upon your credit rating and income, or that of your cosigner. So some also offer higher borrowing limits and fixed interest rates. Private student loans do not require any demonstration of a financial need. So those are some of the positive things of taking out a loan. Private loan terms, including interest rates and fees, vary by lender and usually are determined based on your credit history. And because federal loans offer fixed interest rates, they are frequently considered beneficial over private student loans. So even in our office, when we counsel students, we try to encourage students to consider their federal student loans before taking out private loans because of all the benefits that's built into them. Okay, so private loan terms, including interest rates and fees, vary by lender and usually are determined based on your credit history And because federal loans offer fixed interest rate, I already said that, sorry. They are frequently beneficial over private student loans. There is no one size fit all. So for one student, it might be, beneficial for you to have private loans as opposed to federal loans. And for another student, it might be beneficial to have federal loans versus private loans. So like I said, there's not a one fit size for all. When it comes to paying for college, no matter if you're an undergraduate student, a graduate student, or a parent, is generally best for students to exhaust their federal loans. I'm going to repeat that again, federal loans before considering private loans. Now, keep in mind that there are limits to how much you can borrow. So how much can you borrow? If you qualify, you can have multiple types of federal loans, but there are limits on how much you can borrow in student loans based on your loan type, your year in school, and whether you're a dependent or independent student. There are a few types of federal loan programs, and they are awarded based on eligibility criteria, including financial need, direct subsidized and direct unsubsidized loans, which are also known as Stafford loans, are the most common type of federal student loans for undergrad and graduate students. And direct plus loans, also known as grad plus and parent plus, are available to eligible graduate students and parents. So you see, you have your different types of student loans there. Okay, so whether you're a dependent or an independent student, dependent undergrad borrowers can borrow up to $31,000 total in Fed loans. And independent undergrad borrowers can borrow up to $57,000 total in federal student loans. Now, that's going to be broken down by grade level. And so the over amount that I mentioned is across 4 or 5 years. So that's like the max for the 4 or 5 years that you're in school that independent or undergraduate borrowers can borrow. Okay. We always like to re-emphasize and emphasize to our students that come to us for counseling that to borrow only what you need and what you can reasonably repay. And one way to do that is to compare the estimated starting salary of your future career to your estimated college debt. And so, it's easy to take out loans. It's easy, to take those out and and take more than you need. And most definitely, if you take out more than you need, you do have to pay that back in with interest. And so some students, get caught up with, not knowing what their budget is and taking out more than they need. And it pretty much gets you in trouble later down the road. Another way to keep track of that is to use a debt or salary calculator or a student loan calculator to help you make an estimation about how much you can repay or to pay, depending on what career you're in. So you can find calculators like that on studentaid.gov. Okay. So what is the interest rate? Well, what interest rate you can expect with federal student loans, it depends on the loan type, again, direct, subsidized, and unsubsidized loans. And the interest rate currently is 2.75%, and that changes annually, but for a federal student loan is fixed. So the current interest rate is 2.75%. Every year it can change, it can go up, it can go down, but as far as the life of the loan, it is fixed. So who pays the interest while you're in school? Well, with direct subsidized loans, Students are not responsible for paying the interest that's charged on the loan while in school. But with unsubsidized loans, the interest it will begin to accrue at the time of the loan disbursement. So I always like to break it down break it down for students that with a subsidized loan, if you're eligible, the interest is always accruing on that, but the government pays that interest while you're in school. So you're not responsible for it. So those are some of the benefits that's built into the federal student loans. Payments on those begin 6 months after you graduate. And so they call it a grace period. And so once you graduate from your program, 4 or 5 years, federal government will give you 6 months grace period, and then you'll begin making the payments. I have to also mention that it's not only if you graduate, but if you just leave school and you don't finish, or if you drop below half-time, your payments on that, there's no grace period. If you just leave school or you drop below half-time, your payments will begin immediately for that loan. So keep that in mind. Special note here, if there are any students that have graduated, or you do have a loan that is in deferment or in forbearance, there's due to the corona COVID, the payments and interests on federally held student loans are suspended until September 30th, 2021. So most definitely find out if your loans qualify and what steps you need to take. And you can always call your loan servicer, and you can find your loan servicer at studentaid.gov. So most definitely, check that out. If you do have loans and you have them there in deferment, it has been extended for when that repayment begins. Okay. So for the Direct Plus loan for parents, parents of dependent undergraduate and graduate students can borrow money to help students pay for their education. The interest rates on the Parent Plus loan are fixed interest rates, and they tend to be slightly higher, as you see here. And the borrower or the parent must have good credit to qualify. So yes, your parent would have to apply for this, for the Parent Plus loan. So their credit has to be in good standing. So they have to have good credit to qualify. Parents can only borrow as much as they need to cover their students' college costs. And I always like to make it known that the Parent Plus loan is an option for parents. It's not something that parents have to do to cover their students' tuition. But we get a lot of phone calls where parents say, oh, I was told that I have to take out the Parent Plus loan to help cover my students' costs. And I really don't want to do that. And it is optional. So, it is an option for parents to take out that loan. So I just really want to, reiterate that. Okay, so we're going to move on to some repayment options here. Excuse me. Repayment options. When it's time to repay your student loans, you'll have several repayment plan choices designed to fit your specific income circumstances. So these are some of the benefits that I mentioned earlier, for federal student loans as opposed to private loans. When it comes time to repay your student loans, you'll have several repayment plan choices. And so it's really important for you to, if you have taken out loans, to understand what you have out there, understand your repayment plan before it comes time to repay. So if you're having trouble repaying your student loan, contact your loan servicer immediately. they don't know your situation unless you share that with them. So your loan servicer can help you to understand your options for keeping your loan in good standing. And what I mean by good standing, that means keeping it out of default. And default means that you've missed several payments and now, you know, your credit can be ruined because of it. So just to break it down for you. Now, I have another example. If you wish to change a repayment plan to lower your monthly payment or request a deferment or forbearance, now those are two terms that students will become familiar with if you have a student loan. And a deferment or forbearance allows you to temporarily stop or lower your payments on your loan. And so if you can't pay on your loans because of financial hardship, you've been laid off from work or laid off from your job, basically a deferment and forbearance delays your payment and it keeps it out of default. There are 4 different income repayment plans that are offered under the federal student loan program and are offered for making monthly payments lower. So those are your income-driven repayment plans. But that option will, usually if you take that option, it'll lengthen the term of the loan and increases the interest amount and can be more costly depending on, so basically depending on income over the long term. So it's really important to understand the repayment plans, and you know, there's not one good fit for one student. So you must do your homework, look at the long-term benefits and effects. If you have multiple federal student loans, you can consolidate them into one direct loan with one monthly payment, making it easier to keep up with your payments. Now, consolidation is also a benefit of the federal student loans. It'll take it'll average your interest rate overall across all of your loans, you know, averaging and make your interest rate a little bit lower. But keep in mind that consolidation is not for everyone. So it's important to understand, you know, if that's for you or not. Now you can apply for any repayment options with your student loan servicer. And again, like I said, you can find out who your loan servicer is on studentaid.gov. And so you can sign in with your username and your password, go to your dashboard and find out who your loan servicer is. All right, so managing student loans. So it's really important for you to track your loan debt while you're still in college, track it before you graduate so you can understand, you know, how much money that you've taken out so far, how much you're going to have to pay back. And so you can manage your student loans at studentaid.gov, have it listed here. And basically you'll sign into or sign onto your dashboard at studentaid.gov. Check the status of your loan debt. Also, you can check on studentaid.gov. They do have the loan simulator tool to help you make decisions about your student loans. And you can use it to find like a repayment plan that meets your needs and your goals. So this is a very important site here or tools here on studentaid.gov that you can use. I highly recommend. So take the time to research and develop a plan so you can have your student loans under control sooner than later. I also want to just add a little note here that You never have to pay for help with your student loans. There's free assistance with managing your student loans. And so, like I said, you can go through your federal loan servicer. You also have, go to the next screen. You also have educationquest.org. This is our website. And you can find tools on our website that will help you manage your loans. We also have blogs that will, give you tips and advice. And let's see what else we have. We have our FAFSA tools. Highly recommend that you use our website at educationquest.org. Okay. Okay, well, I know that was fast, short, and sweet. Hopefully I got a little bit of information in there that you can use. And we will now open up the session for any questions that may have come in. As a reminder, if you have a question or a comment regarding what was presented, please type them in the question and answer box, and our moderator will read them aloud. So that being said, Angie, do we have any questions?
Yeah, it looks like we have 3 questions. The first one is, so if I start at one college and take out $5,000 and then transfer to another college, is the amount I'm eligible for start over, or does it include that I've already taken out $5,000?
It does not start over, unfortunately. It does accumulate and it'll be added to your loan balance. So federal student aid is, for any college that you go to, and for, any amount that you take out is going to be added to the amount that you've taken out. So yeah.
Good. The second question is, so if my financial aid package lists a Parent Plus loan amount, does that mean we are receiving that, or that we qualify and my parents will still have to apply to determine if I can actually get it?
Yeah, good question. So yeah, it means that your parent is eligible and they're qualified to take out the Parent Plus loan. They do have to apply for it. So they would have to go to studentaid.gov, and with their username and their password, their FSA ID, they'll go and go to the parent's application, sorry, and they would have to apply for that Parent Plus loan. And in the same day, they would find out if they're eligible for it or not. So yeah.
Okay. And the last question is, can you change your repayment plan down the road if your financial circumstances change, but you don't want to defer or go into forbearance?
Oh, absolutely. None of the plans that you sign up for repayment plans are locked in place. And so the federal government just, assumes that, people's financial situations will change. And so, yep, it's just a matter of you contacting your loan servicer and coming up with the better repayment plan that meets your needs, your financial needs.
Okay.
Yeah.
That looks like those are all the questions. Thanks, Kim.
Awesome. Awesome. Thank you, Angie. So thank you all for attending the Know Before You Owe webinar. We hope you found it helpful, and we look forward to seeing you at the next Financial Friday session, or FAFSA Friday session. No regrets, avoid debt with scholarships and grants. And that'll take place today at 4 p.m. Thank you and enjoy the rest of your day.